very much. We work with companies, helping them with manufacturing operations, business financials, and strategy, as well as workforce solutions. Obviously, a successful business at some point needs to transition, hopefully in a way that the owner wants it to. So today's webinar is to introduce you to a couple of our partners that help our manufacturing clients with that. Next slide, Mike.
Yeah, Marin, I just admitted a bunch of people that are coming in now.
Okay, just admitted one more. Like I said, we're partners. We refer each other to services in areas that we have expertise in. And with that, I'm going to let Patrick and Emily talk a little bit about what they do and the organizations they work for.
Sure. Thanks, Aaron. Good morning, everyone. Patrick Corkin here. I'm with the Rainier Group. We're based here in the Pacific Northwest. We have offices in both Portland and Seattle, and our primary focus is working with owners and founders of privately held companies. Typically, most of our work is helping them, identify, build, and implement a transition strategy. So there's kind of two segments that we think of our business. One is the strategic advisory or consulting side. So a lot of the transitions that we're working on in that category is primarily internal sales to key employees or family members. And then on the investment banking side, we're helping clients with external sales to a third party. Most of the clients we serve are based here in the Pacific Northwest, but also really national as well. And they range from anywhere from 10 million of top line revenue to 100 million. And these are your traditional middle market companies, manufacturing, oil and gas, distribution, branded products. So collectively, since our founding, we've transitioned close to 700 private companies. So, we haven't seen everything, but we've seen a lot. And so it's a pleasure to be here, and I look forward to the discussion.
All right, well, my name is Emily Bergstrom. I work with a group called Project Equity. We're a nonprofit. We're based in California, but we work nationwide. And we do three main things. The first thing is educate owners about employee ownership as a potential exit option. We also provide technical assistance to do two formats of employee ownership conversions, worker co-ops and employee ownership trusts. And then we refer out ESOPs, which a lot of times people in manufacturing are more familiar with. And then we also have an impact investing fund. So we come to the table as a finance partner as well to promote employee ownership. Oh, and maybe one thing I'll mention about myself, I always try to get a little bit of street cred with my manufacturing folks by saying I spent a long time, as 12 years at McMaster-Carr, so very familiar with the manufacturing space. All right, so we thought we'd start out just giving kind of an overview of some of the market dynamics. If you could go to the next one, Mike. So one of the important things, I think, for anyone who owns a business right now and is thinking about exiting in the next 10 years is to understand there's this huge demographic shift that's happening where, many people are of retirement age right now. Over half of business owners in Oregon, and this stat is true across the United States, are retirement age. And so this is really like an unprecedented time for ownership change of hands in American history. And so it's important to understand, we call this a silver tsunami. A lot of people use this this language too, but there are a lot of businesses that are for sale now, and that is going to continue to be the case. And so it's important as a business owner to think of yourselves kind of in that context and do as much as you can ahead to make sure that, that you're kind of ahead of the game. And then, I pulled up these stats. These are from the Bureau of Labor Statistics, just to help folks understand that as a manufacturer, I think there are specific challenges to selling a business. And I just think these stats are so interesting because most businesses across America are small, and manufacturers tend to be much smaller than than businesses of the same revenue size in terms of employees. And so, when we have businesses that have a thin or no management layer, or like a very involved owner, a lot of customer concentration and capital intensivity, those are sort of headwinds for selling a business. And those are often really common in manufacturing companies.
Hey, Emily, I'll add a fun fact there. 87% of the manufacturers in the state of Oregon have less than 20 employees. Yeah,
very, very common. Very common. And when I was at McMaster, I mean, I don't know how many, 20 employee machine shops I visited, but those are the realities, right? We're using capital to do things a lot more than labor sometimes.
Yeah.
Yeah, and so just a quick overview of the current M&A environment. So this would be relating primarily to external sales. I mean, it's been, in short, incredible activity over the last 5 years. And if this chart was to extend back to 2012, you'd kind of see a gradual incline all the way up to where we are today, with the exception of Q2 2020 with COVID. But really what's been driving a lot of this activity is just really historically low interest rates. Pre-2022, there was kind of looming tax changes, which encouraged a lot of owners to go to market to hopefully beat any changes to capital gains. But to Emily's earlier slide about the silver tsunami, that's coming, but it's interesting because there's really been a supply and demand issue in terms of more buyers than sellers, which has just created a really good environment in terms of multiples and valuations for companies that did want to go to market. And then you couple that with, there was a record amount of undeployed capital, especially on the private equity or financial buyer side. You guys might remember, during PPP loans, if you were backed by a private equity firm because there was close to $3 trillion of undeployed capital, you weren't even eligible for those loans. So as we come into 2023, it's interesting because a lot of those fundamentals are still there, but we are seeing rising interest rates, which is starting to lower the multiples a little bit. And it's just because, if a buyer has to, pay more for the capital that they're leveraging to buy the asset, that'll show up in the multiples. So that's one of the negatives that we're starting to see. But these are still, like, historically, if you look at the multiples companies are getting, and when I say multiple, companies usually trade on a multiple of EBITDA, net profit. And so those multiples have come down a little bit. Some of the due diligence periods have become a little bit longer. Taking a closer look, usually we close a transaction at the time we sign a letter of intent, is what we call it. They'd close in about 90 days. Now it might be 120. But the good news is sectors that are showing, resilience, especially through COVID. We used to always talk about the Great Recession. Now we just talk about how did the business do during COVID, have become very attractive. There's still a record amount of undeployed capital. And so I think the biggest change we'll see, though, is in the prior years, everyone was chasing really large assets. We're seeing them kind of shift to the lower middle market, because if it's a complementary business that, bolts on nice or, has good synergies with an existing asset, it's pretty low risk and they still want to grow during, potentially down times. So still a really good time in the overall M&A market. You go to the next slide, Mike.
Yeah, so we tried to give sort of just a big picture of like, where is the world? And then now we'll kind of zoom in, thinking about an individual person. Go ahead, Mike. The question that I get a lot of times from people is like, they just don't know what their options are when it comes time to sell. And I think one of the really key things that you need from an advisor is to help you understand the full suite of options that are available to you. So you want to take it away, Patrick, and talk through those?
Yeah, sure. So, I mean, there's really two options when we think about a transition, right? There's an internal sale. So that's where you're structuring a transition to either one or a group of key employees or a family member. And they're both different, but they have similarities. When it's a family member, you're typically trying to sell the business for what the exiting shareholder needs to fund their retirement and do it in the most tax efficient way for estate planning. Where when it's a key employee, it's also a very amicable sale. I mean, these parties typically know each other for a long time. But you really have, in both those scenarios, you really have to balance essentially the P&L, because what happens is those parties usually take a loan out for a portion of the sale, and then there's some type of ongoing payment that happens either monthly, quarterly, annually, et cetera. So it's really important to stress test, the amount that's remaining that the internal member will have to pay, how that impacts their business to grow the company as you have with this ongoing liability of paying and exiting shareholders. So the more you can just make sure that's successful, it minimizes your risk too, because you're the owner with still, skin in the game, if you will. And that's different with, than a third-party sale. It's a little, less personal, as you can imagine. These are unknown parties. We're usually trying to accomplish the best price and, frankly, the best terms. Also thinking about the employees or potentially the community that you live in. But there's really 3 types of buyers that we consider. Strategic buyers, that might be someone that you compete with, that bolts you on to just kind of expand their geography. Or there's individual buyers, and we're actually starting to see a lot more of that, where these are people that might work in a corporate position and want to own a business, but don't want to start a business. So they'll go out, they'll raise some financing and look for an owner that they can relate to in an industry that they understand, and purchase that from a shareholder. And the last one, and this is, when we talked about undeployed capital, is the private equity side. So these are groups that are raising capital to go out with the intent of buying privately held businesses. This is a really, growing area, and they're very motivated to deploy that capital because really they don't get compensated until they do. So we've seen a lot of kind of aggressive bidders on the private equity side, but generally speaking, those are the 2 main types of transitions that we're seeing in today's market. But Mike, if you go to the next slide, these are just some other options that people don't always think about. And Emily, I don't know if you want to start this off, and I'm happy to kind of.
Sure, yeah, and I'll add quickly on, you were talking about internal sale and thinking about that debt burden, and that's exactly how we think of it with a full employee group sale too. We're trying to figure out, the employees don't come with the money for a sale like that. They're borrowing it, and the business is taking out a loan to sort of to buy itself. And so it's all about what is the debt capacity. And then, other alternatives, it's so important when I have conversations with business owners, really to get to the heart of what their goal is. Sometimes people want to sell because they need to diversify their assets. They're coming to retirement age. Other times people say that they want to sell, but really what they want is to work less time in the business, and so I think a good advisor will spend some time with you trying to figure out what is it exactly at the heart of your exit. What are the important things to you? Because the best exit option is going to need you to have, really clear prioritization of what your goals are. So obviously, people can wait. You can build management. If you need to just take a step back, you can start working on your succession plan internally. You can make a key hire and completely step away, maintain the business, maybe hire a CFO, someone else that can help you run things, and just become a passive owner. And then there's also cases where maybe it makes the most sense to sell or to close the business. But I think what's key with all of this is, 1, understanding what you want as the owner, and 2, understanding, what are the realistic paths of all of these that are open to you. And that's sort of the beginning job as you're thinking through exit strategies.
Yeah. Well, one thing I'd add on passive ownership, this is often a pretty overlooked one, but it can be a great one, especially, we have a lot of clients that might come to us because they want to explore an external sale because there's no one inside the walls of their business that's expressed interest in acquiring the company. But it's also a business that you couldn't sell for, a high multiple or the valuation that the owner wants. So, but it still accomplishes a great cash flow where you can really incentivize your management team with different equity forms to not really think like employees, but think like owners, and continue to run the business in your absence. It does take time. It's a transition. Obviously, you still carry some risk as the actual owner, but it's a great way where you could keep it as a legacy asset for your family and just to continue to collect cash flow from a really good performing asset without having to sell it, and still be able to retire whatever your personal objectives are. So we're seeing a lot more of that these days.
Yeah, and if Mike, if you could go to the next one, I think it's important. We're sometimes in the sort of world of M&A, people use these different terms, and if you don't come from that world, not everyone has heard these before. So, thinking through just the basics of, if you talk to Patrick, if you talk to us, if you talk to a broker, people are going to use this word multiple all of the time. And this is a helpful concept to understand in broad terms. So I always point owners to this data. This comes from the International Business Brokers Association. They have a really cool quarterly report that they put out that I think is worth taking a look. And it shows that, if you just look across like a really long time series, typically businesses will sell for a multiple of their either seller's discretionary earnings or EBITDA, whichever term you want to use. And so if you're a $500,000 EBITDA seller's discretionary earnings business, probably you're going to sell for about 2 times that. And then it kind of, the multiples go up the line. And so if you are here just to think of like, well, what is a ballpark? How do I understand where I fit? This is a decent guide. Every single business is different, and there's, all different kinds of variables that will determine what a sale price is. But if you want just a general understanding of how these things work, this is a good resource. And go ahead to the next one. Another question that we get is, well, how does it work? What are, when do I get my check as the selling owner? And the thing that I always tell people is like, okay, well, no matter who you work with, whether it's private equity or a strategic, or you're selling to your employees, you're going to get some money now and you're going to get some money later. The fantasy that all selling business owners have is that they're going to have this easy process where they get 100% of the purchase price, on day 2 of thinking about it. And that is not realistic. We're here to help you understand how this works. So if you look across, the same data set, this is comparing 2022 with 2012. So, 10 years difference. Most of the time, you're going to get somewhere between, 70 to 80% in cash at close. And that's either going to come from the person that's buying it or the loan that they take out, to buy the business. And then you're going to have some kind of skin in the game for some period, usually like 5 or 7 years, where it's a loan that you're making to that business. And so this is important when you're thinking about your retirement planning, that you understand that there's this chunk of cash that happens now, and then there's some that happens later. And one of the important tools as you're thinking about different structures is to think about the tax implications of when that money comes to you. This is a good thing to talk about with your tax advisor, but there are some structures that can help, optimize your tax profile. And I always tell people it's not the sale price, it's what you actually get at the end of the day after taxes. It's important to recognize those and to be strategic about the tax side too.
Mm-hmm. One piece we didn't talk much about, maybe we will, Emily, is the retained equity.
Mm-hmm.
So the private equity buyers, they typically want some type of retained equity because they don't always drop in to run the business. They would love to keep a management team or an owner that's willing to stick around. And so what we're seeing is they usually want ownership or some form of management and ownership to retain about 10 to 20% of the business. And the idea there is it just lowers their risk, right? They keep the management team in place where they know that you still are attached to the business. The customers know that. And the pitch they would make to the owner, if you will, is, well, we're going to help you grow the business for another 3 to 5 years before we sell the asset again. And it's going to be a much larger company. So you're going to be a smaller part of something large. And so it's just kind of a way that you can increase, to Emily's point, your net proceeds. If you have a 3 to 5 year timeline to stick around prior to a full exit. So we're seeing a lot more of that. Just thought I'd share that.
Yeah, and I was on a call earlier today with a couple of bankers in Oregon, and we were saying, yes, even if you sell to an individual, and they're getting a loan from a bank, they're going to require that seller note too. If you do an employee ownership transition, everyone in this world, that money later piece is all about helping them manage the risk of the transition of buying the business. There's kind of no escaping that, I guess selling to your family. Sometimes you don't have that, but Patrick can tell you that sometimes you do too there.
Yeah,
So
exactly.
you can go ahead to the next one, Mike. Another question that we both get quite often is, well, how long does it take to sell a business? And, it's sort of like asking, how long does it take to sell a house? Each situation is different, but there's stages that you just can't move through any faster. There's a certain amount of time that they take. And so from the moment that you decide to when the purchase agreement is signed, you should plan on somewhere between 2 and 3 years of time between that. And Patrick can tell you there's some places where you can squeeze this timeline a little bit if you're lucky, but it's not really up to you. You're selling your business to someone else, and that other entity takes time to find. It takes time to diligence the company. If you're getting lending from somewhere, it takes time for them to do their underwriting. So, this isn't just like, I'm going to list my business and then I'm going to move to Florida, in 6 months. That's not how things work. So it's important to start early. You can control what you can, and hopefully by being flexible, you can move through that process as quickly as possible.
Yeah.
Could you click that one more time, Mike, so that the words come up? Yeah. So, go ahead.
Yeah, and this relates perfectly into this slide because, getting ready to transition your business, although they can take a lot of different forms, it's always the same type of preparation. I mean, the first thing you can do before you ever, talk to an advisor or anything is really just get your financial house in order. Typically reviewed statements at least, but if you could get audited financials, even better. Any potential buyer, internal or external, is going to need to thoroughly review at least 3 years of financials, maybe more. So the more you can do to get that piece ready is incredibly important. The second one's obvious, but try to transition your business when you're in a good cycle, when it's profitable. That's going to obviously get you the best outcome. And the business needs to be transferable. I mean, if you have one customer, for example, I know this is probably not a likely scenario, but if you have one customer and the relationship's completely attached to you and you want to leave, that's a huge risk to a buyer. So the more that you can bring your leadership team in, kind of diversify the responsibilities, diversify the revenue in terms of the customer base that you have, just the more seamless it's going to make that transition. And that leads right into the last point. It's just going to lower the buyer risk. And that's really what they're trying to assess, is just what's my risk as an acquirer when I take over this business. If X person leaves or X client leaves, what kind of issue could I have on hand with paying the debt service on what I paid for the business? So these are just 4 pieces to really think about. And then of course, consult with your advisors because they can make this process a lot easier for you.
Yeah, and one of the things that we were talking about, kind of preparing for this talk is, the OMEP is a great resource for anyone to just help you run your business well. And nothing makes a business easy to sell like it just being well run. So investments that you make in your time, building up your management team, getting your financials in order, those things all help you now just run the business well, and they'll also help in the future when it comes time to sell.
Mm-hmm.
Oh yeah, I'm ahead of the game here. So what if you're not ready? Number 1, talk to OMEP, as I was just saying. And then, work with your CFO, get your CPA involved. So much of this is about your own tax burden as an individual. And so, you really need to talk to your personal financial planner to hear what they see and be thinking of those dynamics at the same time. And then I think that examining your options really, I've talked to so many business owners who have this concept of what their options might be, but they're not grounded in reality. And so the more outside people that you're asking about your business, the more those options that you're imagining are going to be real options for you and grounded in reality. It's easy and so tempting to just say, oh, well, I'm just going to do this. I'm going to sell it to my son. I'm going to sell it to the employees and have a kind of a vague idea. But if you haven't really gotten outside help sort of talking through what that's going to look like and the specifics of that, it may be that when it comes time for you to do that, it isn't really an option. So we're trying to hammer home this, start early and get outside help. And we wanted to do a couple of case studies just to walk through specific businesses that we've both helped. So the first one here is a client that was referred to Project Equity through OMEP. $10 million revenue. They've got a little bit north of 50 employees. They ended up going with an employee ownership trust. We did some free consultations with them to help them understand what their goals are. As a nonprofit, we can do that. And then, we did a feasibility process where we help, the owner walks us through the P&L. We get to really understand their business. We build financial projections and then kind of work backwards, doing a debt capacity analysis to figure out what the business can afford to pay. Once we had a structure worked out, we developed a buy side within the employee group of about 4 people. Project Equity coached them through that role. We trained them on the financial literacy needed in order to negotiate with the owner, and they're currently working out a purchase agreement this month. So hopefully next time I'm talking with the OMEP crowd, we can share who it is and maybe get them to speak too. But this is a sort of a typical client size for us, and that process is pretty standard. And happy to talk, more specifically if we have questions about how that process works.
Yeah, and this was an interesting one. It was a branded food manufacturer that we worked with, and they came to us with 2 things there, 2 transition structures they were interested in. They said, I think we want to set up an ESOP, but we've also heard valuations are really high. And one thing I'll say is ESOPs are, really common to hear from companies that have attachments to a brand. So breweries or, branded food products like this was, where they want to have everyone kind of share in that success. But a lot of times, kind of like the Bob's Red Mill story, right? And so, but what's a lot of times missed is you're essentially, setting up a public structure with a private company. And so, what we did on this case is we overlaid both those. We showed them what an ESOP would look like, pros and cons. We also showed them what a third-party sale would look like and the valuation and all the things that would go into a process. And really what we learned through that is, they were only trying to incentivize a couple people in their business. That was really their objective. And the valuation that they could get at that time was a little bit shy of what they hoped to get. And there were some things that they could do to really increase the valuation of the company. And so we suggested, well, what about short-term passive ownership? Because it sounds like really your true objective is incentivize these couple people, but phase out to retirement. And so what we did is we created like a synthetic equity plan for 2 of these managers to run the company to where they can make a lot of these changes within the business that would increase the valuation. And so they're still doing that. But what it's also done is it's brought the key management team into the fold in terms of the long-term plan. It's given the shareholders a chance to really go off and retire and let them take the reins. But it's made the business more attractive because they've made a lot of changes internally that they wanted to do to increase their margins. But they've also essentially worked themselves out of a job, which lowers the risk from a buyer. So at a certain point, that company will be transacted to a third party, but everyone's aligned on how that would work, and it's just kind of monitoring when the right time is. So it's a really interesting story of just kind of, it can take a lot of different forms, and sometimes there's an interim solution rather than just exiting at that point. So
That's
not
great.
a common one, but interesting. So
I think that's just one thing I'll add on to that, Patrick, is that a lot of times people think about a sale as like a point in time. One thing needs to happen and then there's like a before and an after. And I would encourage people to think about this as a process, and maybe as you explore different avenues, you may find that you're comfortable in that space for longer. It doesn't have to be so black and white. So yeah, if you go back just to hammer home to what is it that you need to take away? Start early, please. Please, owners, start early. Give yourself the runway to have options. I think sometimes people are afraid to get started, but the truth is the sooner you start, the more control that you'll have and the more you'll be able to choose what happens to you. Market conditions matter. So, if we do have a recession this year, these things can really have a huge impact on the value of the business. And so you need to be in the driver's seat as the owner, ready to hit that wave when it comes and market conditions are good for you. So please start early. And then the second point is seek help. I think as founders, especially, as business owners, we tend to want to do everything ourselves and be very self-reliant. This is an area where good advice at the right time can really make a difference for you. And, this isn't just a commercial for Project Equity or for, Patrick at Rainier, OMEP. You can find help in all different kinds of areas, but just educate yourself, ask questions, talk to your peers, talk to other people that and as often as possible when you're talking about things, get very specific about your business. Because, maybe someone that on the golf course, had this thing happen for them, right? But your business is going to be different. And the more you're talking to a financial, person who's looking exactly at your business as a banker, they're going to be able to tell you what you need to know for your specific situation. And finally, our call here is be strategic. I think sometimes we sort of, don't want this change to happen. Our identity is tied up in our business. And so you kind of want to just not look at it, but you can't be strategic if you're blind. You need to have all the information available to you. And also, just like anything in life, I think the more flexibility that you can bring to the situation, the better your outcome is going to be. So, just be intentional, figure out what is it that you need? What does your family need? What is good, for the business itself? And really take the time to think strategically about this change.
Mhm.
Right. Well, Emily, Patrick, thank you very much. That was great information. Want to take the last, 10 minutes to open this up for any questions. You're welcome to throw it in the chat and I can present them to Emily and Patrick, or feel free to go off mute and ask them yourself. So if there are any questions.
I saw one from Trish earlier about audited financials.
Yeah, why don't you talk a little bit about that, and then and then I'm going to make an introduction.
Sure. Yeah. Patrick, do you want to take that one for your guys' perspective, and then I can share from
Sure.
what I've seen.
Pretty Trish's question. So that could be an external accountant, Trish. I mean, that's certainly who would audit financials. But sometimes, it's pretty common for an external CPA or accountant just to do reviewed financials. Where audited is just kind of an additional layer of verifying that all the numbers are correct. Because what happens is when you go to sell a business, they do what they call a quality of earnings, where they're just verifying that the earnings that we showed them are there, they're true. And so the more forensic that your books have been reviewed, the better. And so just because you have an outside accountant doesn't always mean that they're audited, but that's certainly the step in the right direction, because internal financials are always tricky if you're just doing them in-house, where it's just nice to have a third party verify that everything's done according to what they call GAAP, which is just general accounting principles.
Patrick,
Yeah,
can you talk a little bit about protected margins too?
Protected margins. I don't know if I fully understand the question.
There was just a question said, can you give examples of protected margin?
I think we were talking about, I think the time I mentioned margins, Patrick, is when we were talking about readiness for a business sale. And if I'm hearing this from the right part of the presentation, making your business transferable means that the margin that you're earning in that business can happen for somebody else. And so sometimes you'll hear people say oh, have to have a moat, around your business. You have to have some kind of thing that makes you different, some niche, differentiator that isn't going to go away. And so I think that when you're thinking about margins, so for example, in the case of if you only have one or two customers and they go away, your business can't exist anymore without them. And so that's instability in your profit margin because you're too reliant on one or two clients to give a buyer that sense that this business can keep happening, even if there are some bumps in the road. So
Yeah,
I think that's where it was.
Yeah, thanks, Emily. And another one that comes to mind is like sometimes we'll have clients where they own the building and so they're not charging the company rent.
Yeah.
The reality is when you sell the business, they might have a lease back. And so now the P&L is going to have a lease expense that it didn't have before. So that would be like a negative adjustment to profit. And so, yeah, there's, or maybe like handshake deals that you have with certain vendors that you might buy products from. If all of a sudden the buyer's going to pay more for those products than you were, those are margin deficiencies that you just want to get ahead of. And
yeah, I think a classic,
Oh, go ahead, Emma.
A classic one too is an owner not paying themselves a salary. And so, maybe the person that buys your business doesn't want to run it day to day. Maybe they want to have a manager in that position. So that means that they're going to take whatever it is that you're taking home from the business and they're going to subtract out 100-something thousand for a manager to do some of the things that you were doing as the owner or a salesperson, whatever it is that your role is. They've got to backfill that. And so you can't sort of count yourself as free labor in your business and then point to your earnings and say, oh, this is how much I'm earning, because you do have to be compensated one way or another. So this business can only exist with somebody doing that work and no one else is going to do it for free.
But on the flip side, though, it is interesting because sometimes we'll have owners that are taking really high salaries and distributions, but they might only be performing a general manager role. Yep. And so what we'll do is usually like a comp study of like in your specific geography, like what would a comparable role be? And so a lot of times you can find that there's a surplus of profit in the form of what we call an add back, because the owner's taking a lot more from the business than really the buyer would need to replace them with a manager doing the same duties.
Yeah.
So.
And from the buyer perspective, the fewer variables that there are like that are uncertain, like if you know you have to hire somebody in order to sell your business, just do it now. And then you don't have to do the comp study. You can say, okay, well, I've got Jerry in here. He's doing this job. I used to do it. And so here's what we're doing. Here's how we're performing with him in this role. The fewer things that are uncertain or unproven, the better.
Mm-hmm. Yeah, I see one question here. Oh, sorry.
No, I was just going to say, you saw it. The process of getting an objective evaluation.
Yep. Yeah. So, there's third parties that you could just get valuations done from, but also a lot of advisors that help with transitions. Usually that's just part of their process to help you understand what the value of your company is, a lot of times at no cost. But really what goes into that though is, they look at a lot of the things that we're talking about. What's the true profitability or EBITDA of the business? What are companies that are similar to yours trading for? Because then it gives them a comparable transaction to look at. Okay, a company doing your type of profitability, what would the market pay for an asset like that? So it's not always too costly of an endeavor. It's certainly good to get an unbiased third party of value.
Yeah, and I think too, I'd always think of that show, Antiques Roadshow, where you have like this antique whatever thing, it's worth so much money. Well, it's only worth that if you find the person who will pay that. So I think the best advisor will be someone who has the pathway to make that happen, and can talk to you about that.
So another question came through, and this is a great one. If this is something somebody's interested in starting down the path of preparing, be it a 3-year plan or an 8-year plan, do you recommend any third-party companies to come in and do the evaluation, or is this something that they should engage with an advisor like you two in starting the process?
Go ahead, Emily.
I always think that more information is better. If it were me and I was thinking about selling my business, I would pay the 15 grand or whatever it is in your area to get the valuation, just to have an anchor. And then I would go to another place that, that maybe I would work with and say, okay, well, I've got this piece of data from these guys. Now I'm working with you. The truth is going to be somewhere, in the middle. So I think the more information that you can get, the better. And recommendations, would you all, Aaron, have folks that you would recommend in your like partner list so people could just reach out to you and get a referral?
Yeah, I see Mike's head shaking, so yes.
Yes.
And I don't know, Patrick, I don't know if you have a thought about that too. Like when you have people coming in who have a valuation, do you feel like that has helped them prepare for the conversation with you better, or is it not necessary from your perspective?
No, I mean, well, it's always it depends, right, on valuation and how we view the business, but it's always helpful just for setting expectations and timing for the owners to see, is it the right time or do I still have some growth to achieve? Because usually it's, to fund their retirement. So if
Right.
it doesn't fund their retirement, the timing's probably not right, or you need to have some variation of a different type of transition. But I agree with you 100% that the more information and the more you can do upfront, the better. And Mike, if we have a couple resources we could send as well, that you could share with the group for just starting that type of assessment.
Right, we're coming close to the end. If there's any more questions, again, you can throw them in the chat. We can hit it here in the last minute or unmute and ask. I do want to take this opportunity to thank Patrick and Emily for preparing this information for the audience and taking the time to share. These are two great people that we've worked with in the past. We trust them. They're great resources. If anybody wants to learn more, feel free to reach out to me or Patrick or Emily personally. And everybody, we will be sharing the recording of this webinar with everyone, as well as the slides. And you're interested in learning more, again, you've got 3 names right there that you're welcome to connect with, and we'll make sure you have the right resource working with you.
Mm-hmm.
Thank you,
Thank
Patrick.
you.
Thank you, Emily. Thank you, everyone. Enjoy the snow.
Yeah. Thanks.
Have a great day.
Take care.